Aloha, good morning. Happy Friday, everyone. Welcome to the Chamber of Commerce Hawaii's webinar Hawaii's Tax Cut Key Changes Explained and presented by Hawaii Department of Taxation. I'm Tricia Fatui, Senior Vice President of Business Development and Events at the Chamber of Commerce Hawaii. We're thrilled to have you join us today on this Friday for this insightful session to learn more about tax reforms enacted by Governor Josh Green and the Hawaii State Legislature. Over the next hour, we'll explore how the largest tax cut in Hawaii's history affects you and your business operations. Take notes and learn how to immediately adjust employee state tax withholding to help individuals and families keep more of their hard-earned money. We're so thankful to have our featured guest, Seth Colby, Tax Research and Planning Officer at the Hawaii Department of Taxation, here with us this morning. He will share about how the income tax cut is benefiting you and your employees. Before I turn over the discussion, I wanted to go over just a few housekeeping items. So first, the webinar is being recorded for internal purposes. Also, please submit your questions. So if you have any questions throughout the webinar, please submit your questions through the submit your questions during the presentation by clicking on the Q&A button on the bottom of your toolbar. And for any of you joining by phone, you can email your questions to Ruby at Ruby Sermons at RSIRMANS@cochawaii.org. And I believe Ruby is going to drop her email address in the chat, so that's easy for you to email her if you have any questions. All questions will be reviewed at the end of the presentation. Now let's get started with the program. We're so thankful to have a great group of speakers today. And now I'm going to pass over the virtual microphone to Seth, who will lead the presentation. Seth, it's all yours.
Good morning, everybody. It's nice to be here. So I am going to explain what is going on with taxes in our state. Got a nice presentation for you. So one of the first things I like to do is kind of explain who I am and why I'm in front of you. I'm the Tax Research and Planning Officer, as has already been noted, but what is the Tax Research and Planning Officer? So there is a group of economists, research economists embedded in the Department of Taxation that does research on our taxes. We use the economic information there to produce reports and do economic analysis. We work directly with the governor and the legislature to ensure that tax policies and other types of revenue policies that we take into account all of the economic impacts of these things. So one of the things I did as this was going through the legislature is I worked intimately with the decision makers to help them understand what they were crafting and what are the results. And I will share those results with you. Just as a reminder, I'm an economist, right? So if you do have questions about the tax law change, you're welcome to reach out to me. But if you have questions about your taxes and administration and problems with GET, I am not the guy to talk to, right? So I'm not involved in tax administration per se. I weigh in and we provide analysis on tax policy. I work for the state. I don't work for the governor. I don't work for the legislature. One of the things that we seek to do is provide nonpartisan analysis, right? So we don't really have a dog to pick in this fight. So I think that's important as I explain to you what is going on here. So in 2024, last year, the governor and the legislature passed the most significant tax cut bill in the history of the state. So, right, we're a Democratic legislature, so normally we tend to raise taxes, and it's very rare to have a large tax cut. And they did that. It's going into implementation over the next 7 years, and I will discuss how that is working, right? So I just want to give you a little bit of background about what is going on, what happened and what was going through the minds of the decision makers as they were passing this cut. So first of all, there was a structural fiscal surplus. So that is a very loaded economic terms, and I'm going to impact that. That meant that the state was receiving more money than it was spending on every single year. So every year they had more and more savings, and it was creeping up every year. So one of the things that they were doing was like they thought that the best way to deal with these savings is to actually remit it back to the taxpayer. The other thing that they wanted to do was support ALICE families. ALICE families are known as it's kind of a catchword for asset limited, income constrained, and employed. These are working class families that are struggling here in Hawaii. So one of the things that we do here in Hawaii is we actually have a pretty robust social safety net for the lowest income, but those are for people right around the federal poverty level as defined in Hawaii. Above that, we have less support for these people. And that was one thing of interest for the decision makers. And then finally, the income tax code was just in need of an update. So the last update was in the early 2000s. We are one of the only states with a progressive income tax structure that is not indexed to inflation. So what that means is every year when there's inflation, especially every year when there's inflation, people can get pushed up into higher and higher rates, even though the value of their salary is not going up. Right. So you can think about this in, we added some like really high income tax rates a couple years ago, but the highest rate used to be 8.25%, but that goes into effect at $48,000 for a single person. That is not what most people think of a high income person. And so why does it go into effect there? It's because in the 1980s, $50,000 was a really good income. So if you're not updating this every year, it really drives things up. And this is particularly important in the last couple years where we've had high inflation, right? And in high inflation environments, before COVID and after COVID, prices are up by 25, 30%. So even if you got a 25 to 30% raise, that does not mean the value of your salary has gone up. It just means you're keeping up with the cost of living. Unfortunately, with that 25 to 30 raise, sometimes you get pushed up into higher and higher tax brackets. So that was another thing that they wanted to deal with. Another important piece of the background is in the previous year, they had already passed some very significant tax credits, refundable tax credits for lower income people, right? So one of the things they did is they increased the earned income tax credit, which is we went from 20% of the federal credit to 40% of the federal credit. The earned income tax credit is basically regarded on both sides of the aisle as one of the most effective poverty alleviation tools at the national level, and we piggyback onto that, right? So it's a refundable tax credit, which means even if you don't have a liability, you can get money back. The other thing they did is doubled the refundable food and excise tax credit and increased the spectrum. And they expanded the child and dependent care tax credit a little bit. So that happened in 2023. But I want to show you why they were thought about doing a tax cut. So this is hopefully you can see my cursor. If you're not, please weigh in. This shows you the benefits accrued to different income deciles, right? So here are the lowest income deciles, people making under 21,000, and here are this is the top decile, people making over 208,000. This is for filers married or filers who are filing jointly, married filing jointly, sorry. And what you'll see is the benefits of the tax credits really accrued to people right above the poverty or below the poverty line, right? But this is the ALICE households, right? These are the people that the legislature is really concerned with, and it missed them. So you can, again, this is for married filing jointly, so you should think of things in terms of two incomes, right? So this is $40,000. So this is a married couple making $20,000 a piece, or conversely, it goes up to $150,000. So that's two people making $75,000, also maintaining two kids, right? So most people don't think that that's like luxury living here in Hawaii, and that was a target of this. So the what the main point here is the refundable tax credits really helped those that were most in need, but there was also recognition that they wanted to help working families here in Hawaii. The other thing that I wanted to point out is we had one of the highest tax burdens in the country. So this is for the tax burden, income tax burden for a family of four making the Hawaii median income of $97,000, right? And what it shows is these are all the states that have income tax. And it shows that Hawaii is the second highest. The only state that is higher is Oregon, and they don't have a sales tax. So if you combine the GET with the income tax, we probably have the highest burden on tax burden on working families, right? So again, this is really important to demonstrate that this is for a family making $97,000. This would look very different for a family making $400,000 a year. Well, actually, it wouldn't make. We're the highest. We would be the highest in every single category. We're the highest at low income rates and high income rates. And one of the things I really want to point out to you is sometimes we look to other progressive states like California, but California is right here at the end. The reason for that is California has a very progressive tax schedule that goes into effect at higher levels of taxation. So they don't tax people at lower levels, they tax people at the very high levels. What's unique about us is we have a progressive tax structure, but it begins at like making $3,000 or $4,000. And that's what pushes us up very high. So there was a recognition that the legislature did not want to have the highest income tax or the highest tax burden for working class families. In response, they passed the 2024 Act 46, right? Which is the largest tax cut in the state's history. It does two major things. It increases the standard deduction over 7 years, and it makes important tax adjustments. So one of the things that was very important is they focused on the standard deduction. The standard deduction tends to help lower income people more than higher income people, and you can probably already think why. It's because higher income people tend to itemize their taxes. They take the itemized standard deduction. I mean the itemized deduction. Lower income people tend to take the standard deduction. And there's two big components to why most people take the itemized deduction. One is they pay higher levels of state taxes, so they can take that at the federal level. But the other one is they own a home, right? So most people take the mortgage interest rate deduction. Lower income people tend to be renters, right? So one of the things that the lawmakers are very concerned with is they wanted to benefit lower income people more than higher income people. So they did they forked on the standard deduction. The other thing they did was the tax bracket adjustments. Now, this is going to affect over 7 years. So it already took effect in 2024, last tax year, and they doubled the standard deduction. This year, they've amended the rates, their tax brackets. Next year, they're going to double in 2026, they'll double the standard deduction again. 2027, there'll be another rate tax bracket adjustment. 2028, standard deduction goes up. 2029, tax break adjustment or tax bracket adjustment. And then 2030 and 2031, you'll see other increases to the standard deduction. So this is a slow moving train that's going to increase in intensity over time. This just shows you the size of the standard deduction. So right now we have one of the lowest standard deductions in the country, which is for a single person, $2,200, and we're going up to $12,000 for single people, $24,000 for married filed jointly. This is getting close to what the federal standard deduction is. The other thing that we're doing is we're adjusting the tax brackets. So this is a version of the tax brackets as they currently exist in orange, and the gray is what it will be in 2029, the last year that the tax brackets are adjusted. And a couple things that you'll see, I wanted to point out. So where we are currently is, yes, we have increasing marginal tax rates, but they go into effect really quickly, right? So for most people, essentially, we have a flat tax of 8.25% because most people make between $50,000 and $150,000 in the state of Hawaii. And again, this is for a single filer. And then it goes up. What the tax brackets do is it shifts things to the right so people don't get hit by these high tax brackets initially. In addition, right, you have to remember the standard deduction is also pushing, this is only for taxable income, but we're exempting more and more income at the lower levels, which provides a larger tax relief package. And we're pushing things to the right. The other thing that they've done is at the 9, 10, 11%, which were some of the highest tax rates, state tax rates in the country, they definitely were the highest at the lowest levels of income. They've been pushed out slightly all the way to 475,000 for the highest rate. So there's other states like California that have higher rates of 11 or 12, but they tend to go into effect at $1 million. So we were pretty unique in having a very low tax rates or high marginal tax rates at low income thresholds. So I'm just going to go through this really quickly. I'm going to explain to you how your taxes are work and how this really impacts somebody's taxes. There's some numbers up here. Don't worry about it. Just be calm. I'm going to work it through. And I know there's some CPAs and people who are really interested in numbers, and I really want to show you why and how this tax law is affecting people's tax liability. So when basically you figure out the taxes owed, which is equal to your income minus the exempted amount times the tax rate minus tax credits, right? So in 2023, one of the things that we did was we increased tax credits for lower income people. So that would have lowered their tax liability. But when the exempted amount depends on two things. You can either take the standard deduction plus personal exemptions, or you can itemize your deductions and personal exemptions. I'm going to be focusing on the standard deduction because that is what's changed in the law. But you can think of the standard deduction as the minimal amount that's going to be exempted by taxes. If somebody has itemized deductions that are less than the standard deduction, they will always take the standard deduction. So let's give the example of somebody who's making $75,000. They have 4 exemptions, which means they're married, filing jointly, and they have 2 kids. At $75,000, this is their income, and they're gonna the exempted amount is the current standard deduction, which is $4,400 plus 4 times the personal exemption of $1,144, and then multiply the tax cut minus the tax rates, right? So what you'll see is the standard deduction is the value is about $8,976. Under the new law in 2031, when it all goes through, the standard deduction will be $24,000, right? So instead of deducting $8,976 from their taxable or from their income, they'll subtract $46,000 from their, $28,000 from their income. So instead of having a taxable income of $66,000, they're going to have a taxable income of $46,000. And on top of that, the rate will be lower because the rate is being adjusted. So happy to go through this more in detail after my presentation, but this is how things are working through to lower people's taxes. And the results are pretty significant, right? So again, this shows how somebody's tax liability and their tax savings will change over the next 7 years with the tax law for for a family of 4 making the median Hawaii's median income. right? So they're making $97,000. Right now, they're paying 57, almost $5,800 in taxes. So for a family of four, that's a significant part of their income. At the end, uh, they're at the end of all of this, instead of paying 57 or $5,800 in taxes, they're only going to be paying $2,000 or $1,968 in taxes, right? So that's a huge decrease. What you'll see is this is the current tax liability in red, and it decreases with time. And these are the savings. So from a person's perspective, a tax savings is a net income increase. This means that at the end in 2031, they'll have 3,800 more dollars than they would before, and they'll have 38 more $100 every single year. This is very different from like a stimulus check that you got during COVID, because that's one-off. And what people usually do with one-off savings is they put half of it in the bank account and they spend some. When people's fundamental income changes, they change their whole spending behavior, right? Some might save more, some might spend a little bit more on rent, but it really is significant. And over the 7-year period, it's 20 for this in this particular example, it's more than $20,000, right? So this is real money. As somebody who evaluates social policies for a living, the fact that you can increase nearly or all working class people's in the state by 2 to 3% is incredible. That's incredible social policy. Nobody has to go to the form, to an office to click a, apply for this. This just happens automatically. So this is a big income boost to the state for taxpayers. So what does it do in terms of our tax burden? Again, this is for somebody making, or a family of four making the Hawaii median income of 97,000. We're going to go from the second highest and probably the highest in the country to the fourth highest, or fourth lowest, I'm sorry. So this is significant. Now, again, this is different. This will be different for every single income level, but it really will change the way that the burden that we're placing on our working families. This is how we will rank before and after everything goes through at different income levels. So I want to go through this because a number of you are business owners, and this is going to be very important for you. So before we started, I'm going to just focus on marrying and filing jointly to make it simple. Before all of this started, before the tax credits and everything, we had the third highest rate in the country. With the refundable tax credits that passed in 2023, we went down, and now we will be one of the lowest after when everything goes through. But as you move things up, one thing I want to point out is it still helps, but it decreases. And that's because we're shifting more of the burden from lower income people to higher income people. But everybody will get a tax break. And so one of the important things is, a lot of your constituents and probably a lot of you and a family are in this tax range right here. These are small business owners, right? So if you own a restaurant, you spend your whole life trying to do like owning different restaurants, you're finally successful, you're going to make some money, right? And so instead of being one of the most taxed in the country, you're going to go into the middle of the range. And this is really important for the competitiveness of the state. It has been shown in lots of research that people are responsive to tax burdens, and the people who can move, some people will move out of the state to avoid tax burdens. And not having the highest tax burden in the country should help address our competitiveness, economic competitiveness of the state. Just to go through a couple of things, this is a ranking of how we rank through different business metrics and compared to the rest of the nation. Overall, we are the worst state for business. And you can look at these different things. I won't go through all of them individually, but like through regulations, we have the most regulations, we have the slowest regulations. We tend to have really high wages, but when they're adjusted for the cost of living, we have actually low wages. So employers are burdened with this one fact that they offer high salaries, they have to pay higher salaries, but their employees feel like they're not getting very much. So that puts a unique burden on things. And then our level of taxation is the highest, but this is going to be addressed. So this is a step in the right direction that will affect the competitiveness of Hawaii's businesses relative to the mainland. One question I get over and over again is this tax law progressive, right? So one of the things we have to, economists have a special way of evaluating tax policies. So, and this is through regressivity or progressivity. You'll hear this tossed around in the press a lot, but most people do not understand what a progressive means. Progressive means that you pay a higher percentage of your, like, people who make more money in the higher income pay a greater percentage of their income in taxes relative to lower places. It does not mean dollar amounts. So one of the fundamental aspects of all tax reforms is higher income people pay more in absolute number of taxes. So you can think of somebody who, let's take two examples. One person who makes 100,000 and one person who makes $1 million, right? If we cut the person who makes 100,000, let's say their tax burden is currently 10%, so they pay $10,000 a year. If you cut it by half, it'll save $5,000, right? Now you take somebody who is making $1 million and you pay 10% on that, that's $100,000, more than their whole entire salary. So even if you just adjust it for, like, let's say you reduce their income by 1%, so they're still paying 9%, their tax reduction in absolute dollars is still larger than the lowest amount. And that's just a fundamental aspect of taxes, right? So when economists evaluate tax proposals, they look at progressivity, which is the amount people pay relative to their income, not in absolute dollars. And so how does this tax law change affect people at different income levels? What you'll see is the people at the lowest income levels get the biggest benefit, the biggest reduction in their tax liability relative to their income. A couple things I want to point out is people under 20,000 weren't paying taxes to begin with in our tax code, so they don't get much of a liability. People between 20 and 41,000 are getting over 100%. How can you get over 100% tax reduction? That's because we have refundable tax credits that were made available. So instead of paying to the state, they are going to get money back from the state now. And then as the people's income increases, the benefit decreases, right? High income people will still get a benefit, but it will be much lower as a proportion of their income relative to everybody else. This law will make our tax code more progressive, which means higher income earners will pay more of the relative share of all individual income taxes. Right now, taxpayers making over 150,000 contribute 53% of our income tax. So that we already have a progressive tax structure. But after this, in 2031, they'll be paying 69% of our individual income tax burden. So they're going to be shouldering a larger share of what is going on. This is just another way of looking at progressivity. This is looking at the net income, take-home income increase as a result of the law. And what you'll see is people at the lower incomes, especially in the ALICE incomes, are going to have the biggest increase to their income relative to other income thresholds. Again, this is just another way of showing it. This is our current tax structure. It shows the effective tax rate at different income levels, right? And after in 2031, what you see is this makes it even more progressive because it shifts everything out. So burdens are lower here, and then it increases even quicker. So this slope is higher than this slope, making it more progressive. This is an expensive bill. So we should not be, this is not free money. Money is always fungible, right? So this is money that the leadership has decided rather than they want to spend it, they will give it back to the taxpayers. And this is, over a 7-year period, this is $6 billion, right? So this is quite significant. This represents, in my view, a shift in the governance philosophy, right? That they're going to have a little bit less, so they're going to have to operate with more efficiency than they have done in the past. And that is just a reality to things. How is this going to affect you, and how does this affect people? Well, they raised the standard deduction in 2024. This year is when most people will feel the greatest effects. They're They've already adjusted the withholdings, and hopefully most of you guys know that. They're adjusted withholdings on January 1st, but because this is a progressive and incremental tax law, every year after this, the tax law will be, the withholdings will be adjusted more and more. So most people in Hawaii received a withholding adjustment of $30 to $40 per paycheck. Now that doesn't, for most people, that doesn't feel like a lot, right? That's helpful, but it doesn't feel like tons. But if you take that, multiply that by 24 times over a year, and then next year you take that amount and then add another $50 to it, and then the second year you add another $50, this really adds up to real money for people, right? So one of the things that like a lot of people will probably not feel the entire impact of the tax cuts because this is going into being implemented over a 7-year period. And so just like a frog in boiling water doesn't realize when things are changing, most people do not realize big changes are afoot when things happen $50 to $100 at a time. But I hope my analysis showed you that this is it's a big deal for most working families, for all working families, really. And everybody in the state will benefit from this at some point. It's just some people, lower income people, will benefit more than others. I do want to just say that this represents the largest tax reduction in the history of the state. It will go effect over 8 years. So this year is the first year people are going to experience salient relief. It will make a meaningful increase in take-home income for all taxpayers, especially working class families. This tax law is progressive, and higher income people will contribute a greater share of the tax base when this is all said and done. This is the most efficient way to reduce tax burdens for residents while still taxing non-residents. One of the big decisions, and you often hear about this, is, oh, we should lower the GET, or we should exempt groceries, GET from groceries and take-home food. We've done the analysis many times. Because non-residents pay 30% of our GET, that is through visitors, and that is through the active military, which are not residents. GET is a very effective way of getting non-residents to pay our taxes, but generally, only residents pay our individual income tax. If you don't have to be taxed here, you will not, because we have such high tax rates. So this is a very effective way of helping local families without benefiting our visitors, reducing the tax burden on our visitors and active military people who don't vote. It will improve business competitiveness. And again, this is money that doesn't grow on trees, right? So this represents a new approach to Hawaii fiscal governance, right? They were going to have slightly less money to distribute than before. And that's a reality. And they're going to leave it with the taxpayers. So this is the end of the presentation, but the governor's office, in conjunction with the Department of Taxation, just launched a website where people can go and check out their how this tax law change affects them, right? So if you click on this taxcuthawaii.org, you're going to come to this page, and it provides really basic information. I really encourage everybody, if you're interested, to go there, share it with your employees. It's very informative. I've never seen people so happy about taxes in my life, but people are very smiley here. It also provides a tax calculator. So when I was showing the impacts of this tax law on people making the median income, it's really comes from this type of calculator, which everybody can access using this website. So let's say you're interested in a family of four, so making $100,000. Here's the income, here's their filing status, here's your number of children, two, and you see how it does. And what it shows you is in year 2031, their tax liability is going to be $3,000 less. It'll be over the next 7 years, they're going to save almost $18,000, again, real money. And their after-tax income is, your tax liability is expected to go down by 50%. And here are all the charts, and you can see how everything is working. Here it is. You can change it to if you want to see, one of the things I just said was our tax code is progressive, so you would expect these numbers to go up for lower incomes. So if I did it for just make it easy, 50,000, right? So even though the tax liability deduction in total terms is lower, their their the reduction in their tax liability is much larger, right? So that is just a sign of progressivity. So I'm going to stop there and open it up for questions. And I hope that was kind of a little bit of tour de force, so please forgive me for going quickly. And I can open it up from here. So I see a couple questions, and I'll read them in the chat and then go through them, but please ask more questions if you'd like. I'm happy to answer anything. The question is, are there additional tax credits or deduction businesses should be aware of under this tax reform? No, this is it. I will mention that 85% of our taxes, our businesses in Hawaii are either S corps, LLC, or partnerships or sole proprietorships. Actually, it might be 90%, which means that this individual income tax reduction is actually a bit cut in business taxes, right? Because the way that they pay taxes is it transfers through their organization onto their individual income tax. So this is also a tax reduction on businesses. When it's another question, when we say it goes into effect this year, does that mean the taxes we are filing now or the taxes we will file next year? Good question. So the law passed in 2024. They raised the standard deduction in tax year 2024. That is the year that we're paying our tax. Like right now, I'm working on my taxes, and I'm working on my taxes for 2024. So the only people that are really going to feel it last year are people who take the standard deduction, and their standard deduction will increase. This year, starting January 1st, we're applying new tax brackets, right? So, and we adjusted the withholding to take advantage of that, so people don't have to wait to the very next year to get all advantage of this tax credit. Instead, most of the impact will come through, if you're a wage earner, will come through your withholding. At the end of the year in 2025, you will follow your taxes, and if you compare your state taxes in 2025 to 2024, most people will see that their liability has gone down. So those are the two questions. I see. Oh wait, now I'm going to the question and answer. That was from the chat. One question from Scarlett. Will these tax brackets not shift until 2029, or is there a progressive plan for these changes? So the tax brackets will be changed in 3 different years. One is going into effect in this year, which is 2025. The next time is in 2027, and the third one is in 2029, right? So there'll be 3 shifts. Each one will be quite significant and will have impact on everybody's tax liability. They get increasingly lower the burden as time goes on. You said the state was overtaxing. Will the overtax cover the revenue deficit, or will we have to cut services to pay these cuts? Okay, so hopefully, I think that is a reference to this whole idea that I made about the structural fiscal surplus. So even now, the state is collecting more money that it needs to spend on basic services. So it is putting money into the rainy day fund. You probably heard that it put money in the past into houses for the Hawaiian homelands. It does different things. It is restricting the amount of money that it has to play with, and it is only going, and it gives people back. As of right now, no social services need to be cut at all, right? I don't work for the Department of Budget and Finance, right? So this is really a budgeting question because I work for the Department of Revenue, so I only focus on revenue. But the governor, BNF, the Ways and Means chair, the finance chair, they all agree that no social services need to be cut. The reason nothing needs to be cut, and we need to get is because the state was bringing in more money than what they needed to spend. Is there hope that take-home income increases will decrease the need for social services? I don't think so. I mean, the hope is that people can have their own lives and benefit and do things. In terms of the social services, those are usually based on federal AGI, and it has nothing to do with how much you're taxed at the state level. So if people are receiving this money or SNAP benefits, other social safety benefits, they will continue to do so unaffected. They will just have more income. And then are the tax forms changing? The tax forms will change a little bit, but you're not going to notice. The reason the brackets will change and the amount of the standard deduction will change, but those are just numbers that will change on the forms, but they're not going to be fundamentally reorganized.
That was great. Yeah, that was great, Seth. I have a couple of questions here also. Do you have what immediate steps should employers take to ensure compliance with the new tax withholding changes?
Right. So most employers use some kind of HR service, and we've worked with a lot of the HR services to ensure that they've done the withholding. So double check with them to make sure that they have. If you do not employ our HR service, you are responsible for adjusting your own withholdings. That is all in our booklet A. So if you have questions on how to do that, I would just go to the webpage that I just showed everybody. It's at the very end of my presentation, and they will walk you through on how to do that.
Okay. Yeah, that website Tax Cut Hawaii, there's that Schedule A.
Yep.
Okay. Yeah, I think my next question was a follow-up to that, but I think you've kind of mentioned it. What are potential risks or penalties for businesses that do not adjust their tax withholdings in time?
So in reality, there's no penalties because you are giving us the Department of Taxation usually only imposes a tax when you're not giving us enough money. In this case, you're giving us too much money, and we will give it back to you at the end of the year. Your employees should be a little unhappy with you, right? Because like you're withholding money, their money that they don't have to, but that's just something to keep in mind.
Wonderful. Thank you, Seth. That was so informational. I think we all learned a lot today. Just wanted to say thank you again, Seth, for sharing this very important information with the business community. We greatly appreciate your time and your expertise this morning. And thank you to all of our attendees for tuning in to learn more about how the biggest tax cut in Hawaii's history affects you and your business. If you have any questions, please do not hesitate to contact the Hawaii Department of Taxation or the Chamber of Commerce Hawaii. Don't forget, we have great in-person events coming up. If you're available, we would love to see you there. Please check out our website, cochawaii.org, for more information, and feel free to connect with our team if we can be of any assistance. Follow us on Facebook and Instagram to get connected, and mahalo again for sharing your morning with us, and have a great rest of your day and weekend.